The OCC just conditionally approved Ripple National Trust Bank. On the same day, a regulated European bank announced it is going live on Ripple payments across fiat and stablecoin rails. That combination is not noise. It is the moment the infrastructure stops being theoretical and starts becoming institutionally usable. A lot of people measure adoption by announcements, new partnerships, new corridors, new product pages. And in crypto, that habit makes sense because most networks live or die on attention. But institutional finance is built on a different logic. The real switch is not publicity. The real switch is permission. Who is allowed to touch the pipes? Who is supervised? Who is accountable? Who can issue, custody, redeem, and settle value without sitting outside the perimeter? Today's concrete fact is simple. The Office of the Comptroller of the Currency announced conditional approvals for 5 national trust bank charter applications, including Ripple National Trust Bank. And on the same day, Ripple announced that AMINA Bank, a FinMah-regulated bank with global licensing reach, became the first European bank to adopt Ripple payments for near real-time cross-border flows, explicitly spanning both fiat and stablecoin rails. Here's the contrast that trips people up. To retail eyes, conditional approval sounds like a maybe. It sounds like nothing changed. And a bank adopting payments infrastructure sounds like marketing. But institutionally, it's the opposite. Conditional approval is a regulator saying the model is acceptable, and now the applicant must prove it can operate under supervision. And a regulated bank going live is not a vibe. It is a production decision that carries real compliance and operational obligations. So in this video, we are going to unpack what conditional really means, why a national trust bank is the precise vehicle for custody and settlement infrastructure, what this does to Ripple's stable dollar and its broader stack inside the United States, and why AMINA is not a side story. It is the proof point that this architecture is already usable in the field. Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. The first thing to do is strip away the emotion around the headline and look at the object the regulator is actually describing. At first glance, this looks like just another regulatory approval, another step in crypto's long march toward legitimacy. That's how most coverage treats it, as a symbolic win or as fuel for asset-level speculation. But that framing misses what institutions are paying attention to. The OCC is not talking about a retail bank. It is not talking about a lender. It is not approving a company to take deposits, offer checking accounts, or run a branch network. It is approving a national trust bank charter, a structure designed for fiduciary services, custody, and trust operations under direct federal supervision. That distinction matters. When approvals like this happen, the conversation almost immediately jumps to assets. Which token benefits? Which ledger wins? What it might mean for price. That's understandable from the outside, but it reverses the order of how real financial systems evaluate change. Assets like XRP and Ripple's regulated stablecoin only become institutionally relevant after these regulatory and operational gates are opened, which is why this approval matters far more than any single asset discussion. From an institutional perspective, the asset always comes last. Permission comes first. Supervision comes next. Operational scope follows. Only then do balance sheets, liquidity decisions, and settlement assets enter the conversation. The OCC's announcement also isn't only about Ripple. It includes 2 de novo charters and 3 conversions from state trust companies into national trust banks. That matters because it signals something broader than a one-off decision. It suggests a lane is being normalized. Specialized trust institutions operating inside a federally supervised perimeter, purpose-built for custody and settlement-era financial services. If you want to understand the significance, don't ask whether this is bullish. Ask a more institutional question. What kind of institution is the federal banking system willing to supervise in this category? And what does that supervision make possible? Because in finance, the ability to operate under a specific regulator is not a badge. It is an operating system. It determines what counterparties can do with you, what risks they can underwrite, what committees can approve, what auditors can validate, and what integration conversations even become possible. What this approval actually changes is not sentiment. It changes eligibility. And once eligibility changes, everything downstream, custody, payments, stablecoin issuance, cross-border settlement, can be evaluated through familiar institutional lenses instead of bespoke crypto risk models. That's the real story here. Not excitement, not validation, but the quiet replacement of ambiguity with structure. Now let's address the word that gets misunderstood the most. Conditional approval does not mean the regulator is unsure. It means the regulator has approved the charter in principle and is now imposing a set of pre-opening requirements that must be met before the institution is authorized to commence business. Think of it like this. A national trust bank charter is not a press release. It is a supervised entity. The regulator's job is to make sure the institution is not only conceptually acceptable, but operationally ready. That means governance that works in practice, compliance that is staffed and tested, controls that are implemented, systems that are secure, and capital that is actually there, not promised. So, conditional is the gated build phase. It is the stretch where the regulator supervises the conversion from blueprint to operating reality. And that is why this is a real milestone. If the core model was unacceptable, the answer would simply be no. Conditional approval is the regulator saying the architecture passes the threshold, and now the applicant must prove it can run the architecture under the rules of the banking perimeter. That is not a maybe. It is the supervised runway to the finish line. Once you understand what conditional means, the next question becomes obvious. Why this charter type? Because if your core business is custody, settlement support, stablecoin issuance and redemption, and institutional-grade trust services, a national trust bank is a purpose-built vehicle. It is designed for fiduciary responsibilities and safeguarded assets. It is designed for supervision. And it is legible to the risk frameworks that banks, broker-dealers, and large institutions already live inside. This is also where the narrative gap shows up. Many people still talk about stablecoins and tokenized settlement as if they are consumer products. But the institutional version is not a consumer product. It is a balance sheet object. It is a redemption promise. It is an operational flow. It is a compliance surface. It is a risk-managed instrument that must fit into how large institutions control money movement. A national trust bank charter is a way to make that legible. It tells counterparties, this is not a project running adjacent to the banking system. This is an entity built to be supervised within it. And it also tells you something about Ripple's strategy. Ripple is not trying to become a retail bank. It is aiming to become infrastructure, embedded in the rails, where custody, issuance, and settlement orchestration can be governed, audited, and integrated. Now zoom in on the mechanics. Ripple's broader institutional story has been about assembling components that individually make sense, but together form a coherent operating loop. Payments infrastructure that can move value across borders. A stable dollar that behaves like cash but moves at ledger speed. Custody systems that meet institutional standards. Prime-style capabilities that make liquidity and execution professional, not improvised. Treasury tooling that integrates into how corporates actually manage cash and liquidity. The reason a trust bank charter matters is not that it magically creates new technology. The technology is already there. The reason it matters is that it changes how the technology can be consumed by institutions. Banks and large institutions do not adopt cool tech. They adopt systems that their compliance teams can defend, their auditors can validate, their regulators can understand, and their risk committees can approve. When a stable dollar is issued and redeemed through a regulated structure, the conversation changes. It becomes about redemption integrity, operational controls, governance, and how settlement flows map into reporting, reconciliation, and risk limits. This is also where the phrase financial plumbing stops being metaphor and becomes literal. Plumbing is not what people see. Plumbing is what you trust to work when you turn on the tap. Institutional trust is earned through supervision, controls, and repeatable operations, not through enthusiasm. So the deeper shift here is that Ripple's stack becomes more institutionally consumable. It becomes easier for counterparties to integrate without feeling like they are taking an existential compliance risk. Now zoom out to Europe, because this is where the story becomes real in a different way. Ripple announced a partnership with AMINA Bank, a Swiss FinMah-regulated crypto bank with additional licensing reach across multiple jurisdictions. And the key phrase in that announcement is not partnership. The key phrase is adoption. AMINA becomes the first European bank to use Ripple's end-to-end payments solution, with the stated goal of enabling near real-time cross-border payments for its clients. What makes this different from a generic fintech integration is the specific problem AMINA describes. Crypto-native businesses often run into friction when interacting with legacy banking systems, especially for cross-border stablecoin transactions where traditional banks have not widely adopted the rails. AMINA's position is that clients need payment infrastructure capable of handling both fiat and stablecoin rails simultaneously. That is a very institutional sentence. It is not a retail narrative. It is a description of dual-rail settlement reality. In the next era, institutions will operate across conventional money and tokenized money at the same time, and the winners will be the systems that can bridge that gap with compliance and operational reliability. Ripple's side of the announcement also matters. It frames the partnership as an on-ramp into traditional infrastructure, providing a bridge between fiat and blockchain rails, including the ability to use Ripple's stable dollar and other stablecoins, and to make rapid payouts in multiple currencies. And there is an important continuity note. The announcement states that AMINA was already early in supporting Ripple's stable dollar earlier in the year through custody and trading services for its clients. That means this is not a cold start. It is an escalation of an existing relationship from asset support into payments workflow. So AMINA is the proof point. While the U.S. perimeter is being formalized through a trust bank charter path, Europe is showing production adoption, where regulated banks want dual-rail infrastructure right now. It is easy to hear first European bank adoption and file it away as marketing. But the operational reality is heavier than that. When a regulated bank adopts an end-to-end payment solution for cross-border flows, it is not buying a dashboard. It is making a decision about compliance responsibilities, transaction monitoring, settlement timing, operational controls, and how those flows will be reconciled through its internal systems. And when the bank is explicitly talking about stablecoin transactions, the decision is even more constrained. Stablecoin rails introduce unique requirements around how funds move, how redemptions work, how counterparties are screened, and how reporting is structured. So the reason AMINA belongs in the same video is simple. It turns the story from abstract permission into visible usage. It shows you what the post-permission world looks like when a regulated bank chooses to operate across fiat and stablecoin rails in a controlled way. In other words, this is not a story about crypto going mainstream. It is a story about regulated institutions gradually wiring tokenized settlement into real workflows. Now let's talk incentives, because this is where the deeper structure becomes obvious. Regulators have a core incentive: keep the financial system safe, competitive, and comprehensible. When a new category of financial service becomes inevitable, the regulator has two options: push it out of the perimeter and let it grow in ways that are harder to supervise, or pull it in, supervise it, and define the rules of engagement. A conditional approval for a national trust bank charter fits the second path. It is the system choosing integration rather than exclusion. Incumbent banks have their own incentive. They do not want competition that can offer bank-like services without bank-like costs. They also do not want new entrants to receive a bespoke, easier path that could undercut traditional models. So you should expect friction, lobbying, and skepticism whenever a regulator appears to be opening a formal lane for specialized institutions. And then there is the incentive for the new entrants. If you want to serve institutions at scale, you need to be legible to their compliance frameworks. You need structures that counterparties can trust, not because they like you, but because the perimeter defines how risk is controlled. That is what today's story reveals. The shift is not ideological. It is architectural. The system is deciding where these capabilities will live. So, what changes next, in practical terms? First, a trust bank path changes how institutional counterparties can think about custody and settlement adjacent services. It influences procurement. It influences legal reviews. It influences risk sign-off. It reduces the category risk of integrating into a stack that touches tokenized money movement. Second, it changes the narrative burden. Ripple no longer has to argue that it belongs inside the system. It now has to execute inside the system. That is a very different phase. It is where operational readiness, audits, controls, and reliability matter more than rhetoric. Third, AMINA signals what adoption looks like on the other side of that boundary. Not every bank is going to adopt the same way, and not every region moves at the same speed. But when a regulated European bank explicitly wants dual-rail infrastructure for both fiat and stablecoin flows, you can see the shape of demand. It is not about replacing the old rails overnight. It is about bridging the rails with compliance and settlement efficiency. And that points to the broader implication. The next chapter of adoption will look less like who announces what, and more like which institutions quietly integrate what, because that is how the plumbing gets rebuilt. At the beginning of this video, I said the real switch is not publicity. It is permission. That is the core contrast worth remembering. Retail narratives chase announcements. Institutional reality follows the perimeter. When a regulator conditionally approves a national trust bank charter, it is not handing out optimism. It is defining a supervised lane for real custody and settlement-era services. And when a regulated European bank goes live on a payments stack that bridges fiat and stablecoin rails, it is not signaling hype. It is signaling operational intent. This is what the integration phase looks like at the start. It is quiet, procedural, and heavy with constraints. But it is also the only path that scales, because it is the path institutions can actually use. And if you want to track where this goes next, don't watch the loudest headlines. Watch the permissions, the supervised entities, and the production deployments that make tokenized settlement legible to banks. Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.